3 more days. 3 more days is all you have to worry about when it comes to me talking about that expiring coupon code linked down below. Don't worry, my birthday's tomorrow and that coupon code expires Monday. Check that out for the programs I'm building your wealth link down below. But for today, we must start with catalysts. So in about an hour, we will be getting the PCE numbers. So in this stream, we'll be talking about the personal consumption expenditure numbers. These are the Fed's preferred gauge for inflation. We are expecting PCE deflator month over month to come in at 0. Obviously, if we get a negative read, that would be fantastic. The prior release was 0.1. Year over year, we're expecting a drop from the prior release of 5.5 to 5%. We're looking at core going from 0.2 to 0.3. That's actually ticking up slightly. We don't really like that, but then again, 0.3 annualized is 3.6, and it ain't that bad. Then we've got 4.7 for the prior year-over-year release. Now at 4.4 is the expectation. Again, this report comes out in about 50 minutes time. We'll also be getting University of Michigan sentiment and expectations reads. 1 year expectations for inflation expected to hold steady at 4%. Now, this is obviously going to probably leave pre-market a little bit tentative. Usually when we get PCE numbers, markets are a little tentative in the morning before, and then every bit of trading after matter or is dependent on essentially the result of that PCE. You get a hot inflation report, bad. You get a soft inflation report, good. Simple. Good news is when it comes to the inflation reports, it's usually pretty binary like that. See, when we got retail sales reports, it was not as binary. When we got retail sales numbers for last month and they were down miserably, we're like, yay, it's bad. That's good for inflation. And then we're like, oh, wow, but it's really bad. That's bad for going into a recession. That was sort of the non-binariness of the last retail sales report number that we got, which was a little more heart pounding as a result for the stock market. Whereas with inflation, there is at this point no level of too low. The lower, the better. The faster it falls, the better. The last CPI report was fantastic. Let's hope the PCE report holds up as well. Not as many earnings today. We'll get a little bit of insight from American Express, Chevron, Colgate, and after all, it is Friday, and you tend to get less earnings that come out on Fridays. We do on the 30th, we will be getting the Dallas Fed manufacturing report. That's on Monday. On the 31st, we'll be getting the employment cost index, expecting employment costs for the fourth quarter to have risen 1.2%. Annualized, that would work out to 4.8%. So obviously, if we can miss on the employment costs, that would be great, especially since we go into the Fed meeting already next week. How wild is that? Next week, Wednesday, we'll get to cover J. Powell doing another press conference. That's just in 5 days away. So not too bad. Now, we do have quite a few things to cover today. We'll go ahead and start just by looking briefly here at some of the earnings numbers that we got. We'll start just with a brief summary here of MasterCard. And I'm not the biggest fan of just yapping the actual numbers out to you. I find that relatively boring. I try to look for the takeaways. And some of the takeaways that I've noticed are that both of them missed expectations. Purchase volumes at both, when I say both of them, I should also mention the other company, it's Visa. Both companies, Visa and MasterCard, missed purchase volumes, although both of them did rise. Visa saw purchase card spend up 1.7%, MasterCard up 11%. Both of those were misses, though. And they still expect to grow revenue, but when you adjust for inflation, Visa was substantially negative. MasterCard was actually still slightly positive, leading MasterCard to say that spending is still positive and healthy, but things are definitely growing slower than expected, which honestly isn't that bad of a sign, given that we kind of want a little bit of that balance where, again, things are weakening so that the Fed can relax, but not weakening so terribly that we think we are going into the depths of a 2008 financial crisis again. That we definitely don't want. Although I honestly don't think many companies or individuals are planning for a 2008 style financial crisis. And personally, they shouldn't, in my opinion. I mean, I suppose it's good to have sort of your backup for a worst case scenario, your money for a rainy day, but it seems like most of the company earnings calls that I'm researching indicate that companies actually see this as, look, either we're not going to have a recession, we'll be fine, or we're going to have a shallow recession. And the best thing we could do right now is invest in ourselves. And if we invest in ourselves, then we'll be a better version of ourselves outside the other or at the other end of this recession or no recession. I think this applies individualistically as well. It's something that I've been encouraging for the last years. Like, hey, you know what? As an individual, obviously you could cut back on some of your spending, cut back on margin, cut back on debt, pay down your credit cards, maximize your ability to borrow on like a home equity line of credit when the time is right to go buy for, say, real estate or whatever, and prepare, because usually recessions are great times to invest in yourself. So that works for both individuals and businesses. The goal, obviously, is not to go bankrupt. See, that doesn't work so well if you're a money-losing company like Rivian or Lucid. Then it becomes very, very difficult to invest in a recession because you have no money. And guess what? The one thing is we generally don't have in a recession: liquidity. That's the first thing that goes out of the window. Liquidity, the ability to raise money, the ability to get new financing, new debt, generally goes out the window. Now, Synchrony did come out and indicate that there were some increasing net charge-offs. Basically, they're pre-planning for more expected defaults on their cards. Synchrony Bank is one of the issuers, although I think JP Morgan took over. They used to be one of the issuers for the Amazon credit card, along with many others. They do tend to serve a more low-tier credit customer. And they mention that we should not worry because delinquencies are still below a pre-pandemic level. However, they don't expect delinquencies to normalize until 2024. 25% of Synchrony's borrowers have a credit score of under 650. Even lower credit score borrowers right now, though, are paying back more frequently than they did before the pandemic. It's pretty remarkable. Hasbro, the toy and board game company, is cutting 1,000 jobs after a pretty rough miss on numbers. Jeffries called that a very painful period for Hasbro. Sherwin-Williams also sees a materially softer housing market, as well as Dow Chemicals, which obviously is affected by the housing market as well. I actually think this is a very interesting opportunity to potentially start positioning yourself for taking advantage of housing-related stocks. Residential investments are plummeting. We expect that construction spending will fall substantially as we get into this recession, and the backlog of existing construction projects is cleared out in such a way that I wouldn't be surprised that during a recessionary environment here in 2023, and I've been looking for this coming for almost a year now, I wouldn't be surprised if you have better opportunities to buy solar or green energy related companies for residential investments here in 2023. We'll see, but I would not have high hopes for solar related plays in 2023. However, I would have high hopes at being able to pick them up pretty inexpensively, because I do believe that for the rest of the decade, solar is going to be pretty darn desirable. Next to potentially, of course, and this is an interesting one, offshore turbines. Yeah, post 2025, there are 86 gigawatts of offshore wind turbine projects that have yet to select a manufacturer. Big plays in the offshore wind turbine market are Siemens Gamesa, Vestas, and GE, each looking to capitalize on somewhere between 27, 14, and 11 gigawatts, respectively, of power generation. Now, I always think that's really interesting because wind turbines, especially offshore, well, wind turbines are really popular in certain more rural parts of the world. Certainly, even countries like Germany, you see a lot of wind farms, pretty darn popular. And what you'll actually see is a lot of farmers, they'll themselves invest in wind farms, because once they make the investment, along with the government tax credits, they could break even on the investment and produce cash flow off them pretty darn quickly. But yeah, wind farms are big and long projects that take about 3 years before they actually go from paying a manufacturer a down payment for a turbine to actually getting it. And so that's why a lot of folks are now looking at the post-2025 period of unallocated wind turbine investments. and see it as potentially big investments for companies like, again, Siemens, Vestas, and GE. Kind of wild. Annual offshore wind build outside China will exceed 10 gigawatts for the first time ever per year in 2026. Fascinating. I don't know if I'm going to be buying a wind turbine anytime soon. I think I need to start with a backyard before I could have a wind turbine. Still don't have a backyard, but who needs backyards? It's just maintenance, right? Kids can play in the street. That doesn't sound so great. Anyway, then we've got Google, and Google's it was an interesting piece about how cookie removal, the removal of cookie tracking software, and sort of the Apple tracking transparency update from almost 2 years ago now, is still hurting Google. Now, what's fascinating here is you've got a company that released an open source product called UID2. They use that instead of cookies. And guess what? It's Trade Desk. Trade Desk is still expected to see substantial growth in the connected TV industry. Keep in mind, though, connected TV is just a $14 billion industry relative to the $500 billion digital advertising market. So if the total addressable market for digital advertising is $500 billion, you take 10% of that, you're at $50 billion. 10% of the entire digital advertising market is still over 3 times what the connected TV advertising market is now. So it has a lot of people at least sharing some hopium about digital connected TV. But remember, hope is not an investing strategy. All right, let's take a listen in over here for a moment. Let's see what they're yapping about on CNBC.
The Chinese are going to know where people are going to know details about them. Is that what people worry about? Is that what you worry about? Is it the power and influence that the platform could be used for in the future, which is to say, to try to influence politics? Is it I don't know if it's a monopoly, but the scale and scope of it, insofar as, I've had people say, look, if we would never let a foreign country, if not foreign adversary, own every local TV station in America. And maybe that's what TikTok is, especially for a new generation. Which is it to you?
Look, they're all serious problems and challenges. But for me, Andrew, you really have to ask, again, I go back to, where does this go? Are we going to ban any Chinese company? I'm much more worried about, frankly, Facebook than I am about TikTok today, and the information Facebook has, how it was used to hack one of our elections. So I'm a lot more worried about all these social networks, which I think are hugely problematic in terms of privacy issues. I don't use TikTok. I wouldn't want it on my phone personally. At the same time,
because why? Because you think that there are folks who would hack your phone itself,
yeah,
or because
I don't trust any of. By the way, I don't use Facebook either. Okay, I think we're going to wake up one day, 10 years from now, and realize how destructive all of these social media have been for truth and trust in this country. But that's another matter. I'm talking about the.
Oh man, I'm sorry. This guy's a little too exhausting for me. Let's instead talk about something that could be a lot more, dare I say, entertaining. Yes, like fundamentals. We've got to talk about a ChatGPT style, GPT style play, maybe, potentially. The chips market is going to come under pressure, especially after Intel's miss. However, there is one particular company that seems to be standing out. It still expects over 25% growth over the next year, and is a company that has a backlog exceeding 18 months of production. Some say their backlog is over 2 years of production. It's a company that sells very expensive machinery that makes chips. It's actually a Dutch company with 35,000 employees that people say no one can copy. And that company is ASML. They use a technology that they patented and came up with, in part, or at least with their technology, called lithography, to produce silicon wafers. And they provides some of the machinery to companies like Taiwan Semiconductors and Intel to actually produce advanced microchips, like the 5 nanometer chips that TSMC is now expected to build at a plant in Arizona as they expand under the CHIPS Act in the United States. Now, without ASML, you would lose about 90% of the chip market. Now, that's actually really fascinating because a lot of folks, well, I should say the advanced chip market. A lot of folks are really excited about the potential for ChatGPT to take over, in terms of artificial intelligence and expand substantial use cases for artificial intelligence very rapidly. And so people are going down the rabbit hole of, okay, well, if I want to invest in ChatGPT, then maybe I want to invest in Microsoft. But the problem is a $10 billion stake in Microsoft represents only a 0.5% investment in really OpenAI. If you look at ChatGPT as a percentage of Microsoft's market cap. In English, if you put $100 into Microsoft stock, maybe you're only getting exposure to ChatGPT to the tune of 1/2 cent. Not that great. So that's leading a lot of people to say, okay, well, ChatGPT uses Microsoft Azure at a cost of about 7 cents per query. And so why not invest in Microsoft, right? But wait a minute. Azure is primarily driven by NVIDIA and AMD chips, mostly NVIDIA. So NVIDIA and AMD are graphic card designers, and Taiwan Semiconductors manufactures a lot of those advanced microprocessors, especially the artificial intelligence ones, given that Taiwan Semiconductor has a 92% share of the advanced chip market. But then we go just one derivative further, and where do we end up? ASML, which has 90% of the advanced lithography market to actually provide machines that Taiwan Semiconductors can use to make the advanced chips. So as you're kind of going down the supply chain, I mean, soon we're going to be looking at sand and where we can source silicon for these wafers. But for now, ASML is a little bit of a shocker in terms of how much market share they have. Some call it Europe's most valuable tech company. They produce these machines called extreme ultraviolet machines. That's one of their most advanced machines. They also produce less advanced machines. The more advanced machines cannot be sold to China anymore because they're so critically important for making chips. And so the more research we do into ASML, the more we're like, oh my gosh, there's very little competition for them. Again, they've got about 90% of this lithography market. And they basically, these ultraviolet machines allow the engraving of these tiny transistors that are, again, 4 or 5 nanometers wide. And they do so with these ultraviolet, essentially lasers, and they've got the machinery, which is incredible because they also just released earnings. And what's great is we could take a peek a little bit at their earnings call and look at some of their numbers, and I'll tell you, they're incredible. So here's some of their numbers. We've got a company here that's manufacturing machines, and the machines they're selling have a 51.5% gross margin, which is really incredible because if you think about Tesla again, they sell $100 worth of machines, aka cars. They're taking maybe $20 to $25 of that to their operating expenses. Here, you've got a company that's bringing more than 50 cents of every dollar to their OPEX. Now, that's expected to slow down from about a gross margin of 51.5% to maybe closer to 49%, but still really, really phenomenal. Again, it's a European company, so when we see numbers, we're going to see a lot of guidance and numbers in euros here. But R&D coming in as they're higher as they're expecting to continue to hire individuals, and SG&A expenses up as they just continue to grow their sales and admin expenses because this company's got a massive backlog. These machines that they sell for anywhere between $100 to $200 million, some even more expensive, and so they can in a quarter deliver somewhere around in a year in 2022 of the EUV advanced machines, they shipped just 54 of the machines. I mean, these machines are just as valuable as planes. Boeing's average price per plane is somewhere around $80 million. ASML is selling some products that are twice as expensive as the average plane that Boeing makes. So these are very, very expensive pieces of equipment, and they're really critical in terms of what the future of the chip industry could look like. And they're critical to critical suppliers to companies like Taiwan Semiconductors, which is now a Warren Buffett-backed stock. Now, what I thought was so wild was that despite all of the uncertainty around inflation, macro, recession, interest rates, and despite the fact that they're seeing customers provide evidence of demand weakness, they're still buying the machines to make chips. And what they're simply doing is you've got companies like Taiwan Semiconductors simply operating the lithography machines at lower utilization levels. And so this is where a lot of folks say, well, wait a minute. And this was my thesis initially first. Wouldn't the machine company like ASML suffer in an environment like a recession where maybe Taiwan Semiconductors is cutting back on some of their capital expenditures, which they are, just slightly below 10% cut back from last year on CapEx? And ASML actually touches on that a little bit. They say they see to help rebalance inventory levels, customers are running lithography systems at a lower utilization level, somewhat a lower, and somewhat also lowered. So they also lowered some of their CapEx plans. But they have concluded that customers have made the assessment that the duration of a potential recession is significantly shorter than our average delivery lead time. Now, that's actually quite interesting because it suggests that lithography investments are strategic in nature, which means the demand for these systems remains strong. And basically, companies that would buy lithography machines from ASML are saying, hey, wait a minute. If we buy an ASML machine right now, it's going to take us a couple years to get it. Do we actually think we're still going to be in a recession in a couple years? No. So we may as well continue to make investments and provide down payments now on machinery to make sure we're in the queue to get that machinery when we're out of a recession. This is very interesting because to me, it goes back to the rubber band thesis that I have for demand and supply chains. So the rubber band thesis is pretty simple. The rubber band thesis suggests that, hey, when we went into the pandemic, we had supply chains that kind of looked like this. And with all of the crazy stimulus spending that we had, the rubber band basically stretched to the extreme and in many cases snapped. That's not good. You don't want the rubber band to snap because that's how prices skyrocket, because everybody then has pricing power to the tune of raising nominal prices, and people are paying whatever just to get their hands on things because they've got so much stimulus money. That led to the pretty insane inflation that we're seeing now. However, when ASML tells us, hey, companies are actually just running machinery at a lower utilization level, and they're still investing in the future, it implies to me that the rubber band of supply chains is actually kind of scrunching down. And that as soon as we see a Chinese reopening and the exit of a recession for the United States, we could actually see that rubber band just kind of go back to normal, in that we would just stretch from a scrunchy period to a normal period. And the ASML report really reiterates that that's kind of exactly what's going on. That companies aren't really looking at this recession, especially ones with high cash flow, that say, yeah, we're going into a recession, so we're going to cut all our spending. No, they're seeing this instead as an opportunity to invest more in their businesses, just run some of their machinery at a slower level. This is what we're seeing with Intel as well, right? Intel, terrible numbers. Intel, way worse guidance than expected. PC market down over 33% from their forecast. The demand for memory has plummeted. So you're looking at a lot of pain, at least in the near term, coming off of all of the spending we saw in 2020, 21, 22 in the upgrade cycle for chips. And now with a weakening crypto mining demand set as well, you're not seeing as much chip demand. This is obvious, right? We already knew that. This is why NVIDIA, AMD, Taiwan Semiconductor sold off terribly last year. Samsung also coming out with numbers that are terribly low and miserable. Yet a lot of these stocks have actually risen off of their lows because we see that light at the end of the tunnel, that these companies are making insane investments to make sure they're positioned for what probably is going to be insane growth for the rest of the decade. Bloomberg Intelligence is going as far as calling the chip sector the next oil. In other words, as oil becomes less and less prominent over the next 50 years, it's going to be a while. Oil's going to be with us for a while, okay? It's just going to become less prominent over time. Chips are going to be going in completely the opposite direction. Think about how an average car has over 1,000 chips. And these aren't all like, your motherboards. These could be little chips, like chips that held up Ford assembly lines because they didn't have wiper blade chips. Everything has a chip now. It's insane. I actually remember 10 years ago, actually, it was more than 10 years ago at this point, but I'll just call it about 10 years ago. It was about 11 years ago. I bought a new washing machine, and the stupid thing broke within a week. And I despise the idea of dealing with warranty and sitting on the phone with people. So I disassembled the entire washing machine myself, diagnosed the problem with my little multimeter. It's a multimeter. I like to call it a voltimeter. But anyway, found a stupid 25-cent chip that I suspected was the troublemaker, or some pressure flow measurer or whatever. And I replaced this like 25-cent chip that I had to wait a week for to get. And the shipping costs more than the chip was worth. As soon as I replaced that chip, washing machine worked for another 12 years. It was great. And it really made me realize, like, wow, how important chips are. Just one thing ruins and stops the entire process of being able to use a machine. I mean, this is why we went away from using vacuum tubes for computers or mechanical switches in computers, because one little piece breaks, one little bug, so to speak, and the entire system shuts down. So chips, really remarkably important. ASML here in their report talking about how demand continues to exceed supply. I mean, this is like the Tesla of chip makers here. Memory buyers are making strategic investments because they've recognized that at a certain point in time, the market is going to come back and they are going to need capacity. You do have a 1.5% drag on gross margin coming from inflation. I would say most of that we expect to recover during this year. This actually reiterates what we're seeing with the inflation story for a lot of companies. A lot of companies talking about how they're expecting inflation to really go away over the next probably closer to the second half of the year. Average selling prices of these machines they're selling, sitting at somewhere, of the advanced machines at least, the EUVs, sitting at around 165 to 170 million euros per machine. Again, about twice the cost of the average Boeing jet. Customers, again, seeing some kind of feeling that we might see a chip recovery in the second half of the year. And ultimately, ASML is saying, look, we don't want to skimp on our investments in the first half because we think mid to long term, demand is just going to continue to significantly exceed our build capacity. Sometimes they say by the tune of 40 to 50%. Demand is still higher than what they can make. Anytime you have demand exceeding supply, you're in a situation of pricing power. Simple pricing power. Let's see what else we have here. We've got testing protocols, some chatting about trying to reduce some of the cycles for testing and some of the initial setup for their customers. And we have, let's see, anything else in the earnings call. This earnings call, by the way, from January 25th. So pretty dang new, just a couple days ago. And that was at night a couple days ago. So because it's a European company. So this is really only about a day old. Pretty good here. Of course, we had significant hiring in the course of Q4. Those people we added this year. This is why we saw that SG&A increase, the research and development. We had an increase in wages, of course. But what do we have here? As you would have seen, if you look at the 2025 and 2030 scenarios we've talked about, you've seen it that down a little. That's clearly the intention to get some operating leverage. So that's to say that by 2020, the scenarios of 2025 to 2030, they see the percentage of SG&A and research down slightly relative to sales. that is normal because you want to see an expansion there. That actually is proof of expanding pricing power. If you can maintain margins and actually expand margins by reducing your OPEX relative to your sales, that's good. They're also setting up to get even more complex in their research and development, especially as they're moving from what now is considered an advanced chip of 5 nanometers, maybe even 4 nanometers, down to new chips like this over here, a product portfolio that's going to bring them down to 2, the 1.5, and the 1 nanometer, and even beyond that. So in other words, smaller. So less than 1 nanometer chips for the rest of the decade, things that they're working on now. Now, remember, when we're talking nanometers, we're not talking about nanometer chips. I should clarify. The nanometer refers to the size of the transistor, which is kind of like a non-mechanical switch. So if you're weirded out by the idea of what a transistor is, think about it like a light switch, but instead of being mechanical, it's chemical. Science, chemistry, electromagnets. Anyway, all right. So, and non-physical ones at that, which is also kind of weird. But anyway, okay, great level of confidence and demand, blah, blah, blah. Okay, we kind of get the idea here. But, and then of course, we talk a little bit about how China doesn't get access to the fancy EUVs. But keep in mind, you have to use DUVs to use EUVs. China can't get a hold of the EUVs. So what's China trying to do? Well, China is actually trying to steal R&D and IP, intellectual property, from companies like ASML. So they're having to actually substantially increase their staff screening processes, their security processes, because they basically think China is just going to steal all their information and try to build EUVs themselves. That's pretty incredible. So you've got some serious potentially national security concerns for countries within Europe and the United States, trying to basically protect companies like ASML from letting their machinery, their $150 million machines and the technology around those, to fall into the hands of Chinese. A lot of folks believe that China will ultimately triple down and manufacture their own chip-making machines. Some folks fearful about investing in Taiwan Semiconductors for the risk of Chinese invasion. We are seeing Taiwan also expand their manufacturing outside of Taiwan, though they're pretty confident that China won't invade. China's got enough economic problems to deal with. But I'll tell you, in terms of ChatGPT style stocks that maybe other people aren't talking about, dang, ASML. I mean, we've put days of research into this. I know that doesn't sound like that impressive, but it's actually a lot because it's been something we've been looking at pretty full time over the last few days here. And we're very, very impressed with ASML. I know that sounds like ASMR, and it's like, Kevin, why are you pitching us some random international stock? I'll be clear, I don't own a dime of it right now because I'm still in the research phase, but wow, it's pretty remarkable. What I will do is provide a little bit of fundy on it because the stock has exploded, in recent years here, as well, we've gone through sort of a chip explosion over the COVID pandemic and that. So if we look at ASML, again, it is a Dutch company. If we get a little bit of financial analysis on this company, we can see we've got about 18.47 euros expected of earnings per share by the end of 2023. In a course member live stream, by the way, we've gone through the fundamentals of the company as well from a perspective of the revenue statement, which is also known as the income statement, the balance sheet, the cash flow statement. I do try my best to conduct fundamental analysis like that on a daily basis, whether it's stocks and real estate, with y'all in the course member live stream where we do Q&A together. And obviously, I would love to have you in the course member live stream. So check out those links down below. The next coupon code does expire in 3 days. That's Monday the 30th. And it's the guaranteed lowest price you can get probably all year, but at the bare minimum for 3 months. So we'd love to have you there. So EPS in US dollars expected to be $20 of earnings per share expected for 2030. Looking at the share price right now, sitting at 683 divided by 20 puts you at about a 34 times multiple for this company. Company is expected to grow EPS between 34 to, well, I'll just read it out. We got 34, 25, 26, 25, 9. Those are sort of your EPS growth rates. So if you went with an average EPS growth rate of about 25, 34 divided by 25, probably selling for about a 1.36 times PEG. Not as juicy as some other plays in the chip space, selling for substantially lower PEG ratios, but quite a bit less than Taiwan Semiconductors right now. Fascinating, really, really fascinating company, and quite an exciting argument for potential PP. And PP go up. We like it when PP goes up. No, there's nothing I like more than PP going up at companies. Pricing power is, in my opinion, the number one thing you want to pay attention to. After, of course, you make sure that these companies actually have positive cash flow. I do not believe that in a recessionary environment, you want to be exposing yourself to companies that don't have PP or cash flow. You want to stay away from cash flow, a lack of cash flow. Money losing companies, bad, not good. Anyway, that's potentially another ChatGPT stock for you. All right. Next up, we must talk about real estate. Let's take a moment to talk about real estate. We haven't talked about real estate in a hot minute. So let's spill some tea on real estate, shall we? Okay. The first thing we have to do is complain about Redfin. But I'll do that after I take a sip of coffee. And I want to look at some of your questions actually first. Gamer Dan, are you saying you have 3 courses? I love it. And I love you. Unless you're talking about a 3-course meal. I'm not sure. Kevin, what would you consider a second wave of inflation? I'm assuming you do not expect a steady decline back to 2 to 3%. I don't really understand how this what would you consider a second wave? I'm assuming you do not expect a steady decline back to 2.2 to 3%. Okay. I'll answer that the best I can. So a second wave of inflation, to me, would be any kind of month-over-month reads that give us warnings that inflation on an annualized basis is running amok again. Running amok on month-over-month inflationary reads, in my opinion, would be anything with a 0.4 or greater on the month-over-month reads, because that would show us at an annualized inflation rate of around 4.8%. Those would be red flags about a second wave of inflation. I do not actually believe that a second wave of inflation is possible. I think that ultimately supply chains will keep a lid on inflation. But I would actually expect this year a rapid decline of inflation, potentially below 3% pretty dang quickly. Well, maybe by July, August, September, we could honestly be negative because of the housing sector dragging everything down as a giant anchor representing about 32% of CPI, 25% of PCE. Where we end up leveling off in the future will be quite interesting. I don't really know. Obviously, if we level off in sort of an environment that's sitting below 2%, it just gives the Fed the license to print money again and stop quantitative tightening quite quickly. But I don't know where we'll end up. That'll be the interesting thing. Are we going to go back in the path of the great moderation of negative interest rates? Maybe. Right. Let's see here. How much more metal is in an EV versus an ICE vehicle? Ooh, yeah. Let's just add up copper, shall we? Can we look at Wave? Do you think of them as a viable energy source? What do you think of them as a long-term investment? I don't even know what that is, man. Wave. Like when I type in wave, I literally just get wave power and like hydro. Let me try wave stock. What is this? Eco Wave Power, global ADR. Well, it is ticker wave. Eco Wave Power. You're asking me about a penny stock. Changing the world one wave at a time. It's some hydro stock. It's some hydro penny stock is what you're asking about. Boy, the maintenance on that looks terrible. Think about the rust and oh, ugh. IR. I'll oblige for a brief moment. Let's see what you got here. Report of foreign issuers. Oh my God. I don't care about some philanthropic press release. I want earnings. I want financials. I'll just go to financial reports. Let's see what's inside, shall we? Brief look. Let's see what this is. All right. So brief look. Revenue 242. What is this? Mil of SEKs? I don't even know what that is. Swedish money. Wow. 1 Swedish krona is 9.7 cents. Yeah. Wow. Okay, so you're pitching a penny stock that has revenue of about $24 million and operates a net loss of about $670,000. With margins of, what is that? Barely 20%? You don't want to poop on that. It's not bad. But especially if you're manufacturing product. It's no ASML, but okay, 19.8%. And has this improved at all? No, their net loss has gotten worse. Their sales shrunk. That's not good. A company that's selling $20 million of product had their sales shrink from 21 to 22. Sounds scary. I don't know. I'd like to go back even further to prior years. Do they ever make money, right? I don't know. Let's find out. Let's look at their annual 2019 report. I don't think they're changing anything one wave at a time. I think they're losing more money one wave at a time. Okay, well, what do we have here? Hold on a sec. Oh, they had no revenues in 2019. Fantastic. Q2. So they just, I mean, this is a risky bet. You're looking at a penny stock that has no provable revenues. Here they had, at the beginning of 2020, they had $4 million worth, basically. Wait, no, hold on. 10,000. Oh, what is this? No, this is, I'm sorry, this is way less. Because this is 440,000 krona, which is like $40,000 of revenue. I don't know. I mean, this is like, you'd have to gamble on a penny stock like this, or have some kind of like insider information that this was like the next big thing. Scary. If we are a scrunchy right now and go to normal, wouldn't that imply a second wave of inflation? No. Fair question. Okay, I will add some clarity. Hold on a moment. So going back to the scrunchy example, it should not be confused with, well, if we're a scrunchy and we expand to here, we end up in a situation where we have inflation again. The idea of the scrunchy is that actually companies that want to make product and sell product actually have so much spare capacity and such better supply chains and shipping methods that they would love to have more demand. And rather than actually raise prices because they can't meet all of the demand, they just increase their production output to meet more demand at the same level of profit and the same pricing levels. Think about it. Would you rather, and it's simple, would you rather sell 10 PP widgets, I'm going to call them, where you make $1 of profit each, In other words, you made $10. Would you rather sell 10 PP widgets, or would you rather sell 100 of the PP widgets? There we go. And make, $100 of profit. Well, obviously you would rather sell 100 PP widgets. Now, if your supply was constrained at 75 and you were able to raise the price, and maybe you were able to make, I don't know, $1.20 of profit. So 20% more profit. Well, now all of a sudden you'd be at $75 times 1.2. Now you're at $90 of profit with a 20% price hike because your production is constrained. But the company would much rather not be production constrained and do more units because they would make more money in that example. So here's an example where a 20% price hike actually is not as desirable as just having properly lubricated supply chains. So the idea of the scrunchie is that companies are seeing through this recession, and they realize that once we go back to a regular demand environment, companies never, ever want to be in a situation again where they can't fulfill demand. There's nothing more frustrating than a company that faces a lack of being able to fulfill demand. There's nothing more frustrating than that. You call up a ship, you're like, I got all this product. I got a customer who wants to buy it. Can you ship it for me? Sorry, got no capacity. You got to wait 6 months before we can get you a ship. That pisses companies off. So what do? Well, what did Walmart do? They bought their own freaking ships. And they're like, fine, we'll ship it ourselves because this is bullshit. Right? So companies want to provide goods and services to their customers. Because the other thing is, it's not just the loss of profit in a supply chain crisis, but it's also pissed off customers. There is no customer that wants to wait 6 months for a product. Nobody wants that. No one. There's no one who goes to Walmart and is happy when there are supply chain shortages and there's not enough deodorant on the shelves or tampons. Got to have enough tampons, okay? Not having enough tampons is a bad day. Anyway, a little bit more on the scrunchie there for you. Okay. Well, before we talk about real estate, we have to prepare because PCE comes out in 5 minutes. And a PCE report is a big deal because it's the Fed's preferred inflation gauge. All right, folks, get ready for it because we also get personal income. Personal income expected to be up 0.2%. Personal spending expected to be down 0.1%. PCE deflator month over month, 0. Year over year, 5. I'm going to put these on screen. So you want estimates. First income, 0.2%. Purse spend, negative 0.1%. PCE MOM, 0%. PCE year over year, 5%. All right, we'll see what happens. So we'll slap that up. We have 4 minutes to go until we get those PCE numbers. In the meantime, let's listen to what CNBC is talking about in regards to streaming.
I don't want to be specific on any certain companies, but I think that the concept of national carriers pending regulatory approvals in the U.S. or other countries will happen. And I think whether it's Latin America, Europe, or the U.S., or even eastward, I think there will be more telecom consolidation to come.
What's the latest thing you watched that you really like?
I watched a few things. I watched Fauda on Netflix.
Yeah.
There's not a new one.
I don't care about this at all.
Urban future.
Oh, and
It's
they're on an
only
app.
human.
Boring. This is why the mainstream media is killing me. As soon as I switch to them, it's ads. All right. I mean, I get it. It's not their fault. I mean, you come here and all you get is a coupon code pitch. I guess that's not as bad. Anyway, so Bolsonaro's wife returns to Brazil alone, ending the U.S. vacation. Bolsonaro apparently staying back in Florida. Amex predicts revenue surge after record cardholder spending. American Express said customer spending on its network climbed to a record last quarter, and the credit card giant predicted that revenue and earnings for this year will surge well above what some analysts have expected. Shares of the company rose more than 5%, While volume increased less than expected in the final quarter, revenue is expected to grow by 17% in 2023. I mean, if there's any credit card company that I've always liked, it's been Amex. But then again, I'm not too excited about financials in a recessionary environment. But hey, Amex is expected to increase their quarterly dividend to 60 cents now. Chevron falls on profit disappointment after huge share buyback. And Intel gives one of the grimmest forecasts ever. Americans, now this is interesting. Americans are falling behind on car payments at a higher rate than in 2009. Individuals and Americans facing car repossessions are an ominous sign for the U.S. economy. During the pandemic, a surge in used car prices forced buyers to take on bigger loans for vehicles. Now, more Americans are falling behind on their car payments than during the financial crisis. In December, the percentage of subprime auto borrowers who were at least 60 days late on their bills rose to 5.67%, up from a 7-year low of 2.58% in April of 2021. That 5.67% compares to 5.04% in January 2009, the peak pain period of the Great Recession. Higher interest rates are making it even more difficult to make monthly payments. The average new auto loan was 8% in December, up from 5.15% a year ago. Although if you look at Tesla, they're pitching this idea that you could get a 5.45% interest rate, although that's probably with perfect credit. Anyway, das ist bad news. In the meantime, when we look at bad news, we will also now look at PCE numbers, which come out in about 5 seconds. Who is ready for PCE numbers to make stocks go up or down? I am. All right, here we go. All right, and personal income matches 0.2. Personal spending comes in worse than expected, negative 0.2 versus the negative 0.1 expected. PCE numbers standing by for those, not out yet. But again, personal income. Okay, PCE, month over month, comes in slightly hotter than expected. 0.1 on the month over month PCE deflator. The expectation was 0. Year over year matches 5%. Real personal spending, negative 0.3%. And in terms of revisions, you have a slightly upward revision on the, you have downward revisions here. Personal income revised down last month, 0.3% versus 0.4%. Personal spending revised down, negative 0.1% versus 0.1% prior. You've got real personal spending also revised down to negative 0.2% from prior. So all in all, this is roughly a match across the board for PCE with the exception of the month-over-month number. The month-over-month number coming in, again, 0.1% hotter than expected. But 0.1% is still the equivalent of 1.2% inflation. Pretty darn nominal. In terms of the market's reaction right now, it's relatively muted. A little bit of up, a little bit of down. So relatively muted reaction so far. We'll see if we can get a little bit more data here. Nope, that's about it. Let's take a listen here to what they're saying about it.
Inflation fight. Personal income's up 0.2% on the month, and personal spending down 0.2. Those both match estimates. So bravo to the economists who did the forecasting. The incomes number down from a revised 0.3 last month. Spending is down from a revised negative 0.1. Interesting note here, guys, that and this didn't show up as much in GDP because that comes out as a quarterly number. October personal consumption was up, but November and December down. So the sequential move is to a slowing consumer at this point.
I want you to go to the basics here. I'm always looking as an amateur at year-over-year PCE deflator, and as you mentioned, 5.5 down to 5. But you've been lecturing me in the last 90 days, month-over-month matters. Into this new year, is month-over-month more important to you and the Fed than year-over-year?
Personally, I don't care. But to the Fed, no, seriously, to the Fed, it matters because what they're trying to do is eliminate the base effects from last year. And they want to see what the sequential progress is. If you were going to do a comparison to last year, you might want to do something compared to, say, March of last year when they started raising interest rates. So the year over year is what gets the headlines and what kind of the consumer looks at. But the Fed's looking at the sequential change because they want to make sure that they're getting a regular decline in the numbers. Let me just give you this savings rate. It went up to 3.4% from 2.9%. So that was a concern out there that people were spending down all of their leftover stimmy money. And now it looks like they kept some aside in the month of December. Wages and salaries, though, they sort of decelerate 0.3. November was 0.5. Now revised down to 0.3. So a little bit of slowing on the wage and salary front, which is also going to be good news for the Fed.
Well, basically, this is not really that newsy for the markets. They're basically stasis across the board as people priced in most of this. This was pretty much bang in line with expectations. The one area, Mike, that I want to focus in on, though, real personal spending. When you strip away the inflationary impulse behind it, it dropped more than expected. Are we seeing a consumer that is being warned duly by what's going on and pulling back ahead of the storm?
Well, I think that you're seeing basically that. Now, is it because they accelerated all their spending into October and September was also large as well because they felt they needed to get their Christmas shopping out of the way early? Or is it because people are really pulling back? This is something of a seasonal thing. The last year we saw basically the same dynamic. So are we seeing a change in consumer spending patterns? But you're right, real personal spending lower. Now you're taking inflation out of that. Real personal spending up 0.3 compared to a 0.2 decline last month. So
all right. So one of the notes in the actual report shows us here at the bottom that within goods, the decrease in PCE was widespread. So this is good. Within goods, decreases were widespread. We want to hear that, right? We want widespread decreases in prices, led by gasoline as well as motor vehicles and parts. Thanks, Tesla. Within services, the largest contributors to the increase were spending for housing, transportation, mainly air transportation, and healthcare. Now, again, we expect housing to plummet. As long as it does, we should be okay. Put that in the wrong spot. There we go. Air transportation. Now, this is fascinating because we do continue to see pain in air transportation. And this actually brings me to a report on Southwest, which gives us some more insight into some of the actual inflationary impulses that we're still seeing at the airlines. And we've been studying the airlines here, not as a potential investment, but more as sort of an indicator of what inflation could be doing going forward. Southwest has new 737 MAXs, which fortunately are more fuel efficient. However, there's the expectation that China's reopening could end up pressuring ticket prices. And the assumption right now is that if fuel prices stay stable, we're still going to be putting more pressure on flying. And given that the entire industry is still smaller than what it was in 2019, in other words, it's smaller today than what it was in 2019, pilot costs are expected to continue to go up. Salaries in the airline industries are expected to continue to rise. For pilots, pilot salaries could rise as much as 18% as soon as early this year, potentially another 5% by the end of the year, according to research by Bloomberg. Fares are expected to need to rise from today 19 to 27% just to get to 2019 levels of profitability. That's insane. Think about that. Prices still have to go up 19 to 20% on airfares just to get to 2019 profitability. Now, that doesn't mean prices are actually going to rise 19 to 27% because they might not have the power to do that. Consider, for example, what United Airlines said in their earnings call. They said that if our competitors start cutting prices, we are prepared to cut prices as well because we think we're more efficient. That does not mean you're going to get back to 2019 profitability. And guess what you have more of today than ever before? Debt. In my opinion, that makes the airline industry a terrible investment, but it certainly continues to increase the inflationary dynamic and concern that we have. And if you couple with that Chinese reopening, there's concern that we're going to continue to see inflation, at least in the air transportation sector, which apparently was one of the leaders in inflation for PCE in the report that just came out this morning. Now, there is a suggestion that by a lot of institutions and hedge funds, and I think it's nonsense, but a lot of institutions and hedge funds are calling for $100 oil upon the Chinese reopening. I personally don't see it. It's possible. Brent's sitting at 88.42 right now. It's been slowly sneaking up. But one of the things that I think is quite interesting is what you saw when China shut down and Russia invaded Ukraine is you saw Russian oil, instead of going as much to China because of the COVID pandemic and their lockdowns, their 3 years of lockdowns, and also a removal of Russian oil from other parts of the world, like the United States or otherwise. What you actually interestingly saw was you saw a substantial amount of Russian oil go, guess what? To India. A lot of Russian oil, while it's still flowing to China, went straight to India this year. And you could see that on this particular chart here. While this orange level is expected to rise because this is all representative of a Chinese lockdown era, what you actually have is right after the invasion, the other parts of the world, such as Europe and the United States, saw the purchases of Russian oil almost disappear to nothing. Whereas you have India's purchases of Russian oil skyrocket and basically more than absorb. You could see that more than absorb over here, more than absorb available oil from Russia. Now, what I think is remarkable about that is, guess what kind of companies are starting to all of a sudden dump a lot of money into investing in India? Well, you happen to have one of the largest companies in the world, which happens to be an American company, and it happens to be a company that probably 50% of you are watching me on right now. It's Apple, folks. Apple. Apple wants to see 25% of their manufacturing in India in the future. That they expect to have 25% of their products manufactured in India. And guess who's taken well, maybe not all, but a ton, literally millions of barrels of oil, hundreds of millions, quite frankly, when you add it all up. Who's taking it all? India. So it's kind of interesting. As Europe and the United States, on one hand, say, oh, we're going to make sure Russia pays, and we're going to stop buying their oil, and we're going to put price caps on. Fine, put price caps on. That creates shortages of oil and increases the cost of oil for us in America. But what does it also do? Creates an arbitrage opportunity where countries like India can buy the oil cheaper. And so now you actually have potentially cheaper domestic production in India. And what companies are taking advantage of it? Oh, American companies that are swooping in to take advantage of a cheaper cost of production. It's pretty weird when you think about geopolitics and how on one hand you have to politically show, oh, we're going to punish Russia, but on the other hand, American companies are hopping in to benefit from exactly that. It's expected that India could be getting somewhere between a $25 to $40 arbitrage on the cost of oil. Cheap oil, kind of fascinating. Now, this, by the way, is also expected to impact or be impacted by Chinese reopening, because as India has started taking so much of Russian oil, if China does reopen as strongly as expected, now all of a sudden that Russian oil might not be eaten up by Chinese reopening, creating again shortages. Because now what was otherwise displaced by other countries is getting eaten up by India. So an interesting potential thesis that, yes, maybe it is possible oil could still take up to that $100 range. Personally, again, I don't think so. I'm not a big believer that oil prices are going to run. I think we'll end up relatively stable. And if anything, we might trend down. But that is a big trade that's being done right now, or being made right now. Do keep in mind as well, China itself is expecting some substantial investments, not only into the real estate sector, but also the auto sector. And it's worth considering that for a moment. Right now, and all of this, by the way, contributes to the Chinese reinflationary boom. The first number that you have to remember is that China's discretionary savings is sitting at about $700 billion. That's about one third the size of what the American discretionary savings were. And when you look at that on a per person basis, it's even more wild, given that India has about 1.4 billion individuals. You're really only looking at about $500 of savings, whereas Americans had about 12 times that, or about $6,000 of savings, contributing to that inflationary nightmare. So the per person increase, the per capita increase in sort of available cash is not that high in China relative to what we saw during the US boom, if you will. But in aggregates, hey, $700 billion of a potential built up savings rate or amount is still quite a bit. And it still has that potential for driving some form of inflation, especially since China is now providing guarantees to their developers to help them finally get the real estate industry moving back again. China makes a lot, or Chinese cities and towns make a lot of their money from property auctions. So they're very incentivized to keep the real estate market going. We've seen an 18% decline in sales from January to November of 2022. However, that's only down at about a 6% decline if you go year over year, January to January. And that's because in December and January, you've seen a lot more support for the real estate market in China, which could also be inflationary again. It's easier for real estate companies to issue bonds now because some of the debt is being guaranteed, or the performance of developers is being guaranteed, making Chinese bond debt for real estate companies less risky. That potentially means, okay, great, less of a crazy housing crash, but then it also potentially means, are we going to go back to that speculative real estate bubble that we had in China, where Chinese developers are building ghost cities, literally cities with high rises and no one living there, because the thought of, if we build it, they will come, wasn't actually true. So you had a lot of developers building properties that didn't end up actually being sold or rented to anyone. So there is that risk of creating another bubble environment. And if you create another real estate bubble in China, you're going to have some more real estate induced inflation, especially as more real estate development increases the cost of concrete. It increases the cost of iron, increases the cost of copper, which, as commodity prices go up, what happens? We have supply-induced inflation, which eventually ends up showing in consumer price numbers. So there is a claim to the idea that China is going to be inflationary. Again, I think because of my rubber band scrunchy analogy, that supply chains have become so much more resilient, we probably won't have as much inflation as individuals are expecting. But China doesn't want to be held back. And so they are doing everything in their power, the Chinese Communist Party, to make sure they continue to invest, such as the likelihood that China is potentially going to become the world's number 2 exporter of vehicles, surpassing both South Korea and the United States, and certainly Japan as well. These are all pretty substantial exporters of vehicles. And you've got companies like Polestar being manufactured by Volvo and getting investments from the Chinese parent company Geely, really hoping to take advantage of the Chinese export market. Though cars exported by China are a lot less expensive than cars produced by companies like Polestar or even Tesla. China is really known for its cheap cars, usually exports cars about 30% cheaper than their Japanese counterparts. Cars tend to be exported at an average price of just $13,700. China right now exports about 2.5 million passenger vehicles, but get this, they expect that to grow to 8 million vehicles by 2030. That is 3.2 times the export vehicle market for China by 2030. Now, personally, I actually think that is a big positive for a company like Tesla. You want the winds at your back in China. You don't want China saying, Tesla's American, let's put a lid on them. China wants to do whatever they can to ensure they can get as many vehicles out of China as possible. They are encouraging exports, building more railways, expanding ports as much as possible. And a strengthening US dollar, a weakening US dollar could actually be good for companies that, like American companies like Tesla, that export vehicles from China to other areas. But also keep in mind, only about 45% of revenue for Tesla comes from the United States. So a weakening dollar is going to increase the value of that 55% international revenue, which is great. Okay, so this is interesting, right? So when it comes to inflationary impulses, you have oil concerns. You do have the real estate concern of China. You've got this blowing up, expanding car market in China. You've got inflationary concerns from the airlines, but you've also got inflationary concerns from staples. I hate to say it, but the other day I reported that Procter & Gamble was showing us some pretty concerning inflationary trends. And that kind of slaps us in the face of thinking that, oh yeah, we're definitely going to see deflation, right? I mean, take a look at this. This is Procter & Gamble. This was one of the most critical portions of the report. On the commodity side, we've seen some of our commodities annualized, as you say, shown some decreases. That's great. But the majority of our commodity basket still sees week over week and month over month increases. So they're still seeing pain from inflationary pressures at Procter & Gamble. And I was hoping to get a different story from Johnson & Johnson. Johnson & Johnson, obviously another staples provider. But unfortunately, what we got at Johnson & Johnson was not that. We actually got more warnings about inflation. In fact, Johnson & Johnson told us that in consumer health, they expect to continue to utilize strategic price increases across the portfolio to reduce inflationary demands. You have comments that inflationary pressures are affecting almost all of their cost of goods sold, that their operating margin is expected to be flat, driven by inflationary pressures. Again, that they're expecting to increase prices in certain areas. They do expect that inflation will be better in the second half of the year, but not in the first half of the year, which echoes what we've seen some of the inflationary complaints at Procter & Gamble. Again, they don't expect deflationary relief until the second half. And if anything, they're expecting a worse inflationary impact in the first half. So you have some inflationary concerns. It's not like I don't want to be the person that's saying you're only expecting to see deflation. No, there is still a large inflationary catalyst, and it's sitting in the following areas. It's sitting in airfares. It's sitting in healthcare, which is literally what the PCE report this morning reiterated. The PCE report that just came out 20 minutes ago from the time of this recording. Within services, the largest contributors to the increases were spending for housing, transportation, mainly air transport, and healthcare. So Procter & Gamble and Johnson & Johnson are telling us, yep, still seeing that inflationary impulse, at least for the first half of the year. So you do have some red flags for inflation. You've got the China concern, the oil concern, the China concern being broken into two parts: autos and sort of their expansionary investments, leading to not necessarily higher average selling prices for cars, but a higher demand for commodities. And you got a housing sector that potentially could boom again in China, leading to, again, more pressure on commodities. And you have, again, airlines complaining about increases in inflationary pressures, from pilot pay to just regular wage pay in the job sector for airfares. But then also you have Johnson & Johnson, Procter & Gamble telling us staples are still seeing inflationary pressures, and those are likely to continue for at least the next 6 months. So everything is not great. Yes, we have a lot of disinflationary impulses. The average price of vehicles coming down substantially. Chip sector, prices coming down substantially. Goods generally deflating across the board. Commodities have come down about 20% year over year. But it's reports like this that unfortunately are going to send a signal to the United States that and the Federal Reserve that maybe, just maybe, we've got to keep some pressure on markets, because there are still what I call inflationary embers. And that's a problem. Inflationary embers mean higher rates for longer. Higher rates for longer potentially mean more pain in the stock market for longer. However, and fortunately, following the PCE report that just came in about 20 minutes ago, the stock market has slowly started to trend higher. Maybe, just maybe, the stock market is willing to look past the next 6 months of inflationary impulses that may still exist and the embers. Because remember, even Procter & Gamble and Johnson & Johnson told us we just basically have to get through the next 6 months of inflationary impulses. That's good. And the Fed is also aware that it takes time for higher interest rates to really affect every part of the market. So potentially the light is at the end of the tunnel, even for the staples and commodities. That would be great. But obviously we'll be paying attention to China in the meantime. So I think this is, I think a way to sort of conclude there is I don't believe that the videos that I make by any means are flippant. Although some people allege that because I think all they do is read the titles. I think that the Fed has fought a really hard fight of inflation, this massive fire, and there are still hotspots that we want to pay attention to. We want to make sure those don't pop up again. But I still am of the mindset, and I'm saying this to be very, very clear. And no, it's not to remind you about the 30 or the coupon code that expires on the 30th for the programs on Building Your Wealth. Best price guaranteed for the next 3 months. It's to say that we are in an environment where unless we get a massive black swan and catalyst to the downside, we could see a slow Nike swoosh style recovery of the stock market as markets and the Fed slowly look past the inflation that's still popping up in the embers, as those cool off, and as long as there's no black swan event that leads to some mass capitulation event in the stock market, we might not hit new lows again. The bottom may be behind us. But again, we'll be paying attention to these inflationary impulses. They are rare, and I want to be clear about that. They're rare. In fact, we have more talks about rate cuts and pauses than anything else. Look at the Bank of Korea. First major central bank to start raising rates in mid-2021 versus the US, who raised rates about 9 months later, lift off in March of 2022. They hinted at potentially pausing as soon as February, with their last 25 basis point hike potentially having been January 13th. The Bank of Canada, guess what? Also expects inflation to fall to 3% by the middle of this year. They're predicting no recession, a mild contraction at worst, aka a soft potential landing. And Canada ultimately expects to potentially pause rates, holding them at 4.5% as soon as the next meeting. In terms of the United States, we're expecting a pause with about a 14% chance in March, and by May, sitting at a 58% chance of a pause by May for the Federal Reserve. Federal Reserve might actually follow the Bank of Canada and Bank of Korea in pausing, essentially. We shall see. We shall see. All right. Let's take a listen over to Bloomberg for a moment.
At home, they keep a calendar check on every 90 days. I start screaming about lazy ass kids who go, how can we stay informed and all that? And I go nuts. I say, it takes work.
Well,
you have to work at it.
I
And
actually
that's
was
not
having
there.
a conversation with someone who is in my home about the potential influence that they get from the media that they read on TikTok or Instagram. And they told me, you know what? It's not a big deal. I can discern what's, manipulative or what's potentially influencing me in one way or another. Really? I mean, honestly, this is some of the questions that need to really be discussed.
We got to get ready for next week, a Fed meeting and earnings. As you mentioned earlier, important earnings about the pulse of what America does best, which is technology.
Big tech parade. We got Amazon, Apple, and Google, or Alphabet, as some would call it, on Thursday.
We continue forward on this Friday, and very importantly, in 64 minutes, key economic data. Stay with us on radio, on television. This is Bloomberg Surveillance.
Auto finance is trust.
Pop over.
Surprised by the way the market's taking them?
I'm not necessarily surprised, Andrew. At the end of the day, the market has been hoping, and Joe referenced this earlier, we see this in the Fed funds futures rates, we see this in the 10-year and the 2-year. The market has been anticipating some type of pivot. The market has been anticipating some type of relaxation or at least pause by the Fed. And we're just not there yet. What will rightfully grab headlines is that on a year-over-year basis, the number came down. But probably more importantly, when you look over a month-over-month basis, it's likely to have gone up about 20 basis points. And so as long as that number is still increasing, we can look for comfort in saying that the year-over-year went down, but that probably ignores the base effect and that we're lapping some pretty difficult compares as we go forward.
So what are you doing about it? And what do you think viewers should be doing about it?
I think you'll be shocked, Andrew. I actually looked to be more bullish when I did my year-end lookout, and I looked across 2023 and tried to write down my expectations. I actually started to get very bullish about the fourth quarter in particular. I think we lapped some very easy compares, particularly with some of the technology companies where ad spending fell off, et cetera. I felt that analyst estimates, which are still a problem, they're still too high, Andrew. I thought that when we reach kind of mid-yearish, that we will have gotten the expectations in line with what we're likely to see. And I thought that we'd be past the Fed and looking to the Fed for all of our market movements. I'm now less optimistic about those scenarios. One of them we also touched upon earlier, that we are now 425 basis points into a rate hike cycle, and yet we still have unemployment at 3.5%. Remember, the Fed is targeting 4.5%, if not more, to get that wage inflation under control, which is the primary driver of services inflation. And if there's going to be a duration between when the Fed acts and when we actually see that play out, when we get the desired results in the market, that means this is going to be with us for a while longer than we expected.
But I think part of the question is, I think we know what the Fed's going to do in the near term. The real question to me is what you think the Fed's going to do next fall. And I know that's sort of maybe we're looking too far out, but that's basically what people are betting on, one way or the other at this point.
No, I don't think it is looking too far, Andrew. And I think that's why you hear a lot of folks now subscribing to higher for longer. Their higher is probably less than my higher. Remember, I'm on record as saying I think the terminal rate will likely end up being somewhere around 6%. But I think we'll be in that range for a couple of years.
Say
and if
that
that's
again?
the case,
what do you think the terminal rate is? What did you?
6%.
Take that.
I think we're eventually going to see.
Oh no!
I don't want it to be that.
How can
Guys, don't get me wrong.
Oh.
Okay, we're out of time.
Well, let me ask you this.
All right. So, Mr. 6% over here. Okay, let's answer this. Hi, Kevin. Can you elaborate on your housing crash stance? Distressed debt is less than 1%, and most loans are sub 4% rates. Appreciate all you do. This is correct. So a lot of folks are calling for a real estate crash that could be worse than what we've seen in the depths of the Great Recession. That's bullcrap. This crash, in no way, none of the research indicates to being anywhere near as bad as what we have seen in the Great Recession. Now, let's be real. There is going to be a lot of fear that comes to the real estate market in the next 6 months. Now, I want you to know this. We are, when it comes to getting data, we are 2 months lagged thanks to the way the Case-Shiller index works for real estate. I could tell you today data for January already. I could look at all the numbers, the sales data for today in January. And what does the Case-Shiller do? They spend time looking at November. So this leads a lot of people to believe that real estate prices are actually still increasing because they hear the Case-Shiller index and they hear that, oh, real estate prices November year over year are actually up maybe 4 or 5%. But what's actually happened is that real estate prices have started to come down. And the question now is, how much further will they come down? Do we expect a foreclosure crisis like we had in 2008? Absolutely not. And it's true. It's not only because interest rates are substantially lower or had been substantially lower to where a lot of individuals who actually hold real estate are not in debt distress. In fact, they're much better off just renting out their properties than selling them. There's nothing necessitating them dumping their real estate because unlike in the 2008 financial crisis, we don't have people who signed up for a negative interest rate to be able to qualify for the loan. And then we're told that don't worry, when your rate readjusts to a 7% interest rate, you could just refinance it. Oh, but wait, prices were falling, so you can't refinance anymore, but you can't make a 7% payment because you were never qualified to pay that. And what happens? You get foreclosed on. We now have ability to be repay rules where the entire set of payments that you make, you have to qualify for, no matter if you started with a lower interest rate or you end up with a higher interest rate. So for example, if you have an adjustable rate mortgage, you have to show that you can actually qualify when and if that rate adjusts up. You have to qualify for all of it. That's really important. That alone is a huge difference. You also don't have ninja loans, which were no income, no job, no asset loans, where basically dead people were able to get loans. You have a pretty stringent lending environment where the average credit score of a home buyer before this started a recent tick down, although it's probably still in about this range. The average credit score of a buyer over the last 10 years has been in the range of 740 to 780. Average credit score of a home buyer back in the financial crisis was closer to 650, substantially weaker. Now, if we look at the fear that's coming, though, and this is the big fear that folks are going to capitalize on substantially over the next few months, it has to do with median sales prices changing. Take a look at this. What you want to do here is you want to look at the blue line, and I want you to pretend that this blue line stays stable, that is, home prices don't actually fall anymore. But let's just say home prices stay stable at a national median sales price of $350,000. Well, if you draw this line stable going over to the right, what happens right now? Well, it actually shows that it's still above the red line. So it shows that home prices are still up year over year, right? But what happens when that blue line is right here under the big black line? And all of a sudden in February, we see that home prices were $353,000 last year. And today they're $350,000. Well, what are you going to see? Oh my gosh, real estate prices are down 1% year over year. You're not going to hear the Case-Shiller index tell you that home prices are down 1% year over year until April. What's going to happen then when you go to April of 2023, when you're in April and you get that first negative 1%? What are actually home prices down year over year? Well, if they're still at 350 and the median home price then was 374, well, then you're going to look and you're going to see that home prices are actually down about 6.5% year over year in April, but the Case-Shiller won't tell you that until June. And so now people are going to think, oh my gosh, the housing market's getting worse and worse and worse. Panic, panic, panic. That's when the real pain comes, in my opinion. And unless interest rates fall dramatically, the 10-year Treasury goes down to say 2.5 to 2.75%. You're not going to see a floor put under the real estate market. Instead, you'll get a lot more fear because now you actually have year-over-year price declines. And when you get to the worst part is when you actually see home prices year over year at the end of May go to a high of 389,000. And if they're just stable at 350, assuming no further declines, if they decline more, it'll be worse. But assuming no further declines, you're looking at about an 11% decline in prices year over year. That'll get reported not in June or May when it actually came out, but probably in July or August. So you've got another 8 months of bad news actually baked in to the mainstream media narrative for real estate coming ahead of you, not behind you. So the bad news technically is still coming. Now, of course, people like me are going to continue to report what's actually happening with that 350 number today. We could do this by looking at MLS data to get exactly what our most recent data is, given that the Redfin data center is about 1 week delayed, but we could also go into individual regions, either through the multiple listing service with realtors, or you could play around on the Redfin data center, and you could actually see that in the case of Austin, you had another decline last week in median home prices. You're down to 450 in median home prices. That compares to a peak of 572. 450 divided by 572, that is a 21.5% drop is what you're going to get reported eventually. It has already occurred from peak to now, but the lag of that release is going to be quite interesting. Now, you do have people like the CEO of Redfin trying to mislead you into saying that, oh, well, the housing market is getting better. The first violation of the CEO of Redfin, in my opinion, is totally forgetting what happened in January of last year. Let me make that clear. Here, he tweets and says, in the second week of November, the number of people going on a home for a tour with Redfin agents was down 33% year over year. But by the third week of January, that number was only 19%, down 19%. which is still bad, but it's better. And they did the same analysis for people making offers. I reply tweeted to this and I said, dude, January of 2022, everybody stayed inside because they were afraid of Omicron. I know that sounds wild, but in the last 3 weeks of January, you had very few people going out to restaurants, movie theaters, real estate. People didn't want to get on me, or they were sick at home with on me. So I think that's a bad comparison. And you shouldn't make that kind of comparison. And again, I am not a real estate like mega bear who's saying we're going to have a worse than 2008 crisis. But things are probably going to get worse before they get better unless that 10-year treasury yield plummets fast. This is what you want to pay attention to. The 10-year treasury yield. Yes, it's come down off of the 4.25% where it was in September and October. Yes, it is lower. Great. But if it shelves over here at 3.5%, it is still remarkably higher than the 1.5% we had when interest rates were like 2.5% for real estate and mortgages. Mortgage rates are still sitting at 6 to 6.5%. Your buyer purchasing power is still down 40%. And when you factor in the fear that's coming, you're probably going to have more pain than not. But that doesn't mean 2008 level pain. It just still means more pain. Also, consider this. Institutional redemptions for real estate investment trusts are still in backlog. That means companies like KKR or BlackRock are still having to potentially liquidate real estate to give their investors the money they say they will give them. This same thing is happening in Australia right now. Dexus announced the sale of 6 properties for 483 million Australian dollars in December, signaling the willingness to dump assets just to provide the redemptions they promise to their clients, to their customers. In America, we have KKR, Blackstone, and Starwood. All of them are potentially facing liquidations due to withdrawal requests. So think about what you do have as a setup for 2023. You have year-over-year FUD in terms of price decline news that comes out. You have institutional liquidations, not necessarily individual homeowners dumping who've locked in 30-year fixed rate loans, but institutions who have to dump when they get redemption requests. They don't have the luxury of saying, but guys, we locked in 2.5%. People are like, give me my damn money, right? That's the way institutional investments work. So you probably have more institutional liquidation along with a massive backlog of new construction, the highest backlog of new construction that we've seen since 2006. So yeah, there is bad news. Again, I don't think it's as bad as 2008, but it's certainly not good. And here's another offense that really just pisses me off. I think the CEO of Redfin is just pissed off that their stock is down. Redfin stock year to date, positive 41%. Sounds really good, right? Sounds great. 1 year, down 76%. If you go even further and you go back to the peak, it's even scarier. This thing ran up to $96, which means peak to trough, this sucker's down 93%. Yoicks. I actually bought Redfin at $9 in the pandemic. And I sold most of my Redfin about $40 because we saw this real estate crash coming from a mile away. And there is no way like 30 to 50% of agents are not going to leave the industry. That's bad. When volumes transactions go down, you lose money at Redfin. You lose money at Zillow. You lose money at EXPI. So not investments I want to be exposed to. But this right here just really grinds my gears. The CEO of Redfin says bidding wars are still the exception but not the rule, and says this is a property in Sarasota, Florida, which just got 23 offers. And me, having previously been an eBay seller, I know I can get a lot of offers for things if I just list it at $1. And then the market sets the price, right? And then I could tell everybody how I got 100 offers on my property or my product or whatever. And it makes it seem popular. But I actually tweet replied the CEO, and I used Zillow to help me. And I wrote, detail helps. A $299,000 listing is what the CEO is talking about here, which was listed in a neighborhood where other properties are listed for $400,000 to $525,000 as list prices. So in other words, you underlisted a property potentially by over $100,000 and it got 23 offers. Duh. You could have the market fall another 20% and still be up money on that deal if you get it for the right price. So another misleading thing. So we got the misleading information about Omicron. We have the misleading information about the multiple offers property. Here, when we talk about Seattle, seeing potentially 12 offers on a $1.4 million listing with $155K over asking for the home, what do we have? No link to the listing. So I can't even look up and see what's going on over here. Let me tell you about Seattle, because I just visited Seattle to look at the real estate market. You know what I learned? The agent's talking to me about how they're not getting inbound referrals anymore because people are leaving. Amazon vacating a 28-story office building, relocating 2,300 employees from the office out of Seattle. They're pausing development of their campus in Bellevue, Washington. Why do I have this sort of data? It's because I'm running a real estate startup. We're starting a real estate startup. It's a startup after all, called House Hack. Learn more about House Hack, go into househack.com. We'll be doing a Reg A release probably in about 2 months. But anyway, Meta subleasing 2 of its Seattle offices because it's laid off so much staff they can't pay the rent without subleasing the empty space. Microsoft is letting 3 of its leases expire. That's 1.7 million square feet of offices, and new offices that they were planning, they have canceled. The downtown Seattle office, the Downtown Seattle Association, that is, says that half of Seattle's core space is office space, and new leases are down 33% compared to before the pandemic. This makes sense because you've got massive layoffs coming to areas like this. 6% layoff at Spotify. Tesla's laid off a ton of white-collar workers. Google's laid off 12,000 workers. You've got Wayfair laying off 1,750 workers. Microsoft, 10,000 workers. Meta, 11,000 workers. Snap, 20% gone. 13% at Lyft gone. Twitter, more than half gone. Salesforce, 10% gone. Coinbase, 20% gone. Redfin, multiple rounds of layoffs. Opendoor, multiple rounds of layoffs. I think you've got 2 like 20% layoffs at Opendoor. The amount of layoffs that are happening in tech are insane. So if you're going to be the CEO of Redfin and you're going to tell me that a listing in Seattle got 12 offers, but you're not going to give me the listing link after your last listing link was basically fraudulent. It's fraudulent, in my opinion, to say that a listing got 23 offers and not tell the world that it was potentially underlisted by as much as $150,000 or as much as $225,000. That's misleading. I mean, that is just pure deception. I don't know if he's just trying to pump the stock or what, but I used to hold Glenn Kelman in esteem, but this kind of stuff pisses me off. It makes me think you don't know what you're doing. You're the CEO of Redfin. You're not actually providing context. And instead, what are you doing? Is you're providing quotes about how Redfin agents are saying, oh, things seem to be getting better. We used to say, take your time, but now we're not saying that anymore. Now we're saying the bottom is in. Let's go buy. I have 5 people looking to get pre-approved, says one lender. Well, how do we know your lender, A, isn't just a slowbie, and B, oh my gosh, imagine that in January, people want to get pre-approved. Duh. When do most buyers buy? Most buyers buy in March. Most sellers sell in July. Of course, more people are going to get pre-approved. That's just the nature of what happens in the cyclicality of real estate. Or let's get some more quotes instead of facts. On some listings, I'm starting to see offer deadlines again. It just bothers me that you have a CEO that rather than providing data, like their own Redfin data center will provide, rather than looking at that sort of data, we're using anecdotes to talk about the real estate market. It's just ridiculous. So again, do I expect the real estate market to crash like 2008? No. But you look at the home builders and they're struggling. Contracts at D.R. Horton down 38%. They had contracts come in, as they just reported earnings, at just 13,382 versus the 14,528 that were expected. Massive moderation in demand for housing. The same thing is happening at KB Homes and a lot of the other builders. KB Homes down like 68% in contract signings. Or sorry, their cancellations are up to 68%, which is way above the usual like 12% cancel rate you see on new construction. It's insane. So yes, I do expect there's pain coming to real estate. Again, do I expect it to be as bad as 2008? No. but is there pain coming? Oh, yeah. Oh, yeah. Now, what I do think is interesting, though, is you do have entertaining commentary on Redfin from a lot of clueless people on real estate, or Redfin, Reddit, I mean. And some of them were actually entertaining to look at. And, oh, wow, one of them has been removed by the moderators. Anyway, there was this post about, pretty sure wife hates the house we just moved into. And when I was reading the post, this person's talking about how they bought a home on septic and on a busy road. And I'm like, first of all, you're an idiot. You should have taken the 0 to Millionaire real estate investing course, which tells you not to buy a yeah but. A yeah but is a property where, like, look, I bought this cool house. Yeah, but it's on a busy street. Yeah, but it's abnormal in your area to be on septic. It's stupid. You're selling an abnormal product. And even if you want to go rent it out, you're going to have less desirable tenants who find it okay to live on a busy road and more likely to move and GTFO. If your wife moved into a house and hates it, what do you think the wives of tenants are going to think, or the tenants themselves, whatever? What do you think they're going to think when they move in? They're going to hate it too. Don't buy abnormal real estate. Don't be a dummy. A dummy in real estate is somebody who buys a yeah but. A yeah but is any property that's next to an auto repair shop, a graveyard, on a busy road, or worse, all three, which I have seen before, next to a graveyard, auto repair shop, and busy road. That's stupid. Properties under high tension power lines, not normal power lines, that's normal, but high tension power lines. Stupid. You'll glow in the dark and die. There are some properties you just don't buy. Now, I don't know what it is with Reddit removing a lot of the posts that I'm trying to talk about here, but you actually still have the picture here. This is a good one. They actually wrote, a rare time in which you wish you had an HOA. This is another thing that I actually teach in the 0 to Millionaire real estate investing course. Coupon code expires January 30th. You want to buy properties in a homeowners association to rent them out. Most home buyers who come to me are like, why would I want to buy a home in an HOA? They're going to tell me what to do. Well, then don't do stupid shit. It's very simple. An HOA is almost like a property manager for the neighborhood. It makes sure people aren't dumb and leave rusty water heaters on their lawn, park on the grass, or put billboards in their front yards, or do stupid stuff like this picture here, where you have a Joe Biden poster saying he has dementia, Jared Polis sucks, Joe Biden's an idiot, Biden remorse, Biden wasn't elected, he was installed. Oh my God. Anyway, so like these are the stupid things that HOAs prevent, because these are the things that ruin neighborhoods. These are the things that make a mess. And you might agree with those posters, but you don't want that in your neighborhood because it's going to lower property values in the neighborhood. It's going to lower desirability of people wanting to buy. I don't care if you're a Democrat or a Republican, but if I am a real estate investor, I want your money. That's the way it works. I want you renting my properties, and I want you demanding to rent in my neighborhood because it increases rents. It increases sales prices. I don't want dummies like this jerk with all his signs ruining property values in the neighborhood. I don't want that. And so I actually prefer to invest in neighborhoods that have small HOAs. Again, you've got a rules body. You've got a way to actually force compliance. It's a great thing. You don't want people leaving their Christmas decorations up all year long because they're too damn lazy to take it down. That's how you ruin neighborhoods. I've gone through 2003 built neighborhoods. There's a 2003 built neighborhood in my city, and then there's a 2004 built neighborhood in my city. One of them has an HOA. The other one doesn't. The one that doesn't have the HOA has people growing squash in their front yards, RVs parked all over the place, and everyone painting their home a stupid, insane, different color from black to neon orange. I kid you not. I will take you through that neighborhood and show you it is stupid. You go through the HOA neighborhood that has an $18 a month HOA. No RVs, no cars parked on the grass, consistent paint schemes. Wow, higher property values. Imagine that. Imagine real estate actually being better when you have some homogeneity and conformity and you don't have stupid yeah buts. Wow, I don't know. Real estate's simple, but apparently a lot of people don't think so. Freaking real estate. All right. I think it's time to go to the course member live stream. But I do want to do a quick check of the sticks. All right. So, quick check of the sticks. Here we go. Quick check of the sticks shows American Express is up 6.8%. I'm going to go through that earnings call in our course member live stream. Actually, the earnings call won't be out yet, but we'll go through the fundamentals of American Express in the course member live stream. Tesla is up about 1.29%. That's actually impressive after the 11% run it had yesterday. Intel's down about 9%. You've actually got a nice little discount here on ASML, 2.81% as Intel is falling. That's okay. The chip sector is not nowhere near out of the woods. Therefore, NVIDIA is down about 1.5% as well. Embraer down about 1.68% after Boeing. Not a lot of remarkable movement over here. You do have, what is this? Tattooed Nut. Oh, wait, sorry. Tattooed Chef up 3.7%. It's $1.40. I was about to say what our boy Strongman usually says. Tattooed Nut. I'm not gonna say it though. Anyway, U.S. Treasury yields 10-year up to 3.54%. Pre-market mostly negative for the indices. Dow's roughly flat, down 4 basis points. S&P down 40 basis points. NASDAQ down 0.57. Well, that does it, folks. Thank you so much for being here. I'm going to go check my blood pressure and go to a course member live stream. Thanks again. We'll see you in the next one. If you want to join me, use that coupon code.